Number one rule of Wall Street. Nobody, I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways, or in fucking circles. Least of all stockbrokers. Right? It's all a fugazi. You know what a fugazi is?
No, Fugazi. It's a fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
Right.
All right? Right.
Another month just went by. We wrapped up the month of May as for markets and the calendar in general, and we are now approaching June. So welcome back for another weekly market recap, or slash monthly wrap up if you want. And you're gonna understand the reference to it when we will look at the charts. But anyway, markets have been particularly volatile intra-week as well. But overall, in the grand scheme of things, nothing really changed one way or the other. But again, we will get into the charts. But before that, as usual, let's have a look at the economic calendar first. Now, there wasn't a lot, especially at the beginning of the week. It was a short trading week because of festivity. What was that? Memorial Day? Yeah. So nothing on Monday coming out of the US. On Tuesday, we got a few data on, trades, so like, durable goods orders and something about the Conference Board consumer confidence and the Dallas Manufacturing Index. Okay. I was, although I don't really pay a lot of attention to the housing market. These data right here coming in lower than the previous read and lower than expected actually caught my attention a little bit, and it might be interesting to check it out later on in the video if we talk, or if I remember to talk about inflation a little bit. Okay. But as for the rest, consumer confidence ticking up a bit. So might be consumers are now a bit more confident. Um, I don't really know, or think you might see an uptick here and there in the data. One data point doesn't make a trend, but it's much more interesting when you pair it up with the manufacturing index coming in not only better than the expectations and better than the previous read, although still in negative territories, right? But if you then check the sectors as for the month, you see that consumer discretionary was one of the sectors leading the charge and is good month for the S&P. And another one was industrial, right? So they were the second and third best performing sectors overall in the index after, of course, technology. So, you could see a positive correlation in between these performances and the fact that overall, it looks like we had a little bit of a bounce in consumer confidence and the manufacturing index, just out of curiosity. Then going ahead in Wednesday was a day full of stuff. If you just look at the economic calendar, it doesn't look like a lot. We got mainly the FOMC minutes with some, officials talking about this and that. The usual talks about rates. Should they be dropped? Should they not? Should we wait? Should we just wait and see what's going to happen with tariffs? But again, the thing about tariffs was hilarious because if you remember, what we had was it started out with some local court in a minor jurisdiction, I guess. And don't quote me on the information because I'm not American, as you know. So, but again, it looks like those tariffs, there was an injunction against the tariffs, and it quickly escalated, and they were deemed as illegal. Now, it just lasted so long because after less than 24 hours, they were immediately reinstated. But now, it looks like the entire thing could escalate up to the Supreme Court because apparently, if you're American, I don't need to explain you that, but the president, for all the rest, if you don't know, if you're not American like I'm not, I needed to ask around and to document myself a little bit. But it looks like the president can only issue uh, executive orders on some specific topics and in some specific circumstances. So it looks like Trump exploited a law which is particularly old. I don't know if it from back in decades ago to kind of establish a state of emergency now, and the solution should be the tariffs to prevent, it was some sort of a matter of national and economic security. So it kind of took the liberty to issue these tariffs. But now the controversy is about, was it really an emergency, or could really the president impose those tariffs without congressional approval? And again, it's gonna drag out for quite a bit of time, I think, especially if we go to the Supreme Court. But it's not, at least to me, from a market perspective, it's not really important if at the end of it tariffs are legit or are not legit. What matters for me is that all of these just adds up to the uncertainty, right? And again, because we already the kind of the policy of the orange men are like, I threaten these, but then I give you the stick first, but then I come up with the carrots. All right. So tariffs on, tariffs off, and now tariffs on, but maybe they are illegal. So not only you need to account for Trump volatile type of character, but also for the art of the deal, but also now for the potential legal issues with that. So again, bureaucracy will step in, and if you consider that now, I mean, put yourself in the shoes of the other part negotiating with Trump. Let's say, since I am in the EU, right? Let's say I'm the EU. Now you come at me saying, you need to do this, you need to grant us much more favorable conditions on trades, because otherwise we're going to do XYZ with tariffs. And now the EU could potentially, again, potentially say, we don't even know if you could actually impose those tariffs on us, standing to your own judges. So why should you believe? Sorry, why should we believe you? Uh, you know, to some degree, those start to seem like empty threats, right? So maybe it's you that should just readjust your expectations and your demands when you come to the table to negotiate to us. I mean, I don't know. It's just speculation, of course, but I'm just saying it adds up a lot to uncertainty overall. And again, it is reflected in markets. Now, I don't know if I stated here on YouTube, but my favorite tool currently is the financial juice app, or website. Because at the end of it, I mean, you really need to keep it up on one of your screens overall, because it helps a lot kind of make sense of what the market is doing on a daily basis, and sometimes from 1 hour to the next, right? But again, moving along, bunch of data coming out of Germany. We don't really care if you, I mean, if you do live in Europe like I do, maybe you check them out, since again, Germany is still the most the biggest economy in Europe. Spoiler alert, it's not doing fine recently. So what we got? Thursday again, the usual initial jobless claims, yada yada, same talks. What has been said about them over the last, at this point, 6 months, still valid. Just check the trend and you're fine. I mean, you're fine. You can assess whatever you're trying to assess, I think, just looking at the trend of these. was interesting the GDP coming in. Now, quarter over quarter for Q1, it came in negative at minus 0.2, which of course it was better than the forecasted minus 0.3, but still a negative print. So now the problem and the dichotomy in the data is, could we see actually two consecutive quarters of GDP contractions in the US? Because again, remember, these are just estimates, right? You can see by the P, right, the preliminary release, right? So look, I don't know what GDP it's going to be, right? What we know now is that the previous read was negative because supposedly it was all due to the front load because of tariffs. So people started to buy up what they needed because they thought it could have been much more expensive to buy that up if they waited for tariffs to kick in. But then again, tariffs were announced and then immediately suspended. So we just pull forward future demand, and by how the GDP formula is calculated, if you massively increase the imports, that is going to be a drag or a negative of subtraction overall in the GDP formula, then therefore it's going to increase to reduce the final result or output. So I guess, if you check GDP now, for instance, what they are estimating now for Q2, it's basically 3.8% GDP quarter over quarter for Q2. Um, it looks a bit optimistic in my view because, I mean, could this be that now that all this front loading of tariffs is in the past, we can get back to a normal situation, whereas the US economy is really growing and running hot? I I would take this data with a huge grain of salt, in my view. Same as if you remember when they were forecasting a minus, what was that? At a point, it was a minus 3 point something, almost 3.8% in Q1. And I said in a video, it looks very realistic to me. And eventually it came in at negative 0.3. One's adjusted for imports, one adjusted for the gold imports, especially. So, this data right here, this estimate, it's very volatile in my view. I don't think it's very reliable overall. But nonetheless, that doesn't mean that it couldn't drive sentiment in the short term, because I'm sure many different people are looking at this, right? Uh, I think overall, you know, I'm not saying GDP should basically crash. I'm just saying probably it's not going to be 3.8, right? At least in my view. On Friday, we got the trade balance, which came in very positively. Of course, it was hard to do worse than the previous read, but it was also above consensus, so good one there. And then we got PCE. So PCE, as you well know, it's defined as the favorite data set for the Fed as for grasping future inflation or inflation expectations. So therefore, this is a data which can move the markets a lot. It's not only about PCE, it's also about personal income, but most importantly, personal spending. And here's another dichotomy, because if you just look at the personal income coming in better than the forecast and better than the previous read, you might say, okay, so people are earning more, which in and of itself, if you remember 2 weeks ago, we were looking at average hourly earnings, average weekly hours. Are we sure people are earning more? Just to start out. But then you pair up these data point right here with the personal spending, which actually disappointed. I mean, it came in with consensus, but compared to the previous read, it was lower. So how does it work? Yeah, I might earn more, but if I do spend less, how does it work in a consumption driven economy? It's the same old dilemma about inflation. Everyone looks at the money supply and they say if money supply goes up, inflation should go up. Yeah, sure, but if those money don't circulate, they don't chase goods and services and chase prices higher and higher, you're not going to have inflation or, you know, price increases, right? If those money are just idling somewhere. It's kind of the same when you look at the consumers, that they might earn more, but if they don't spend it, it doesn't really impact positively the overall economic growth rate, in my view. Then what we got was Chicago PMI, but didn't really pay a lot of attention to it. Michigan consumer sentiment came in a bit better than consensus and kind of in line with the previous read. So again, if you circle back to the beginning of the week with the consumer board, consumer confidence, consumers, it looks like the sentiment it slightly improved, at least for this round of data release. Okay, but again, I think you should look a hell of a lot deeper than the headline because look at this. This is from the what was that? The Bureau of Economic Analysis, I guess. Many different bureaus in the U.S. This one, and you got the BLS, the Bureau of Labor Statistics, whatever. But basically, it looks like personal income increased. Yeah, but at the end of it, if you scroll through the report, right, you see that PCE at the end of it, uh, it just decreased. So again, there is, I think there's more to the story than just the headline. Okay, now just cut out these um, parentheses on the economic calendar. It was already long enough. So let's move to the charts. All right. Let's have a look at these charts, kind of following the same theme of, I wanted to structure the video with a little bit of, me looking at things and just thinking out loud. So not really structured, not really elegant, if you wish, but just to highlight a bit of a thought process. And again, it could be wrong, it could be right. Uh, that doesn't matter really. I mean, it doesn't matter for you. You could have a whole different set of ideas, biases, and opinion. I'm just sharing my own, which again, it is absolutely no guarantee it's going to be correct. But just to give an example on how you could tackle things and try to establish logics for this and that. So having a look at the DXY, what we've seen is we bounced, opening up the week, and then we had these Thursday reversal, and we closed kind of where we started. Not really, but kind of there. Now, what I wanted to do, since we just closed up the month, is to just zoom out a little bit for the sake of it to see where we are in the grand scheme of things. So let's start out with the weekly. So now what we see is that when you start to look at these segment right here on the weekly time frame, it doesn't look super bullish for the DXY. Okay, we got a massive expansion to the downside. We bounced, exhaustion to the upside, so the bounce failed. A huge, nice and thick bearish candle to the downside, and now this week it looks like we started to rally and we were rejected. So again, not the most bullish sign for the DXY in this context. It could change. Well, yeah, absolutely. We have seen it in the past when it was looking the most bearish, like in this case, for instance. We then went for a massive rally. But at the current moment in time, I'd say it it should lean a bit on the bearish side of things. Although, if you zoom out enough on the monthly time frame and you start to look at these like these, right? I mean, the dollar is doomed, the dollar is fucked, even against its own peers. Is it? I mean, maybe, maybe not. It looks to me that over the last 15 years, this thing overall only went up. So that's the problem with narratives, again, as I always say. Now, as for next week, I don't I don't have a particular strong opinion one way or the other. I started out this week expecting a little bit of a retest of the lows, which admittedly we didn't have. right away. Actually, we started out the week in the opposite direction. But with this rejection right here, um, can we hover around these lows a bit more and then decide if we really want to test it, or if we can reaccumulate and try for another push? I'd say at the current moment in time, a retest it could be more likely, but overall we are still operating in this sort of a choppiness. So I guess I would stay neutral up until the point I'm told otherwise for now, and that would be it for the DXY. Now, when we compare the DXY with what happened with all the other major currencies, we've seen basically the dollar Canadian pushing up again. So the reaccumulation we were discussing, the push up, another little bit of pullback, and then again a bounce. So cool for the loonie, I guess. The euro, after reclaiming this range last week, he retested it once again and he confirmed he wants to stay in this range, at least for the time being. But again, just try to throw a slight tint of neutrality and choppiness on these markets right now. Again, it goes along with the speech about uncertainty from a volatility standpoint, from a liquidity standpoint, from a policy risk standpoint. So you can have different biases all around, but I would err on the side of caution in whatever type of direction you are more oriented toward, right? The British pound hit that level we were looking at a few days ago, was in here, and he just had that type of reaction that you expect when you get into that sort of levels, right? Nothing crazy. I mean, it doesn't mean that we are going to completely reverse, but it just means we are going to draw back the leg, which was very inefficient to the upside, was very sharp. So, a little bit of a pullback was due, I guess. Um, Same for the yen. We were rallying last week, then we pulled back, and so far we bounced. But again, it looks more choppy than anything else. Still, the worries about the carry trade unwinding and whatnot, I keep on saying to myself that up until the point this thing moves slowly and orderly, you don't really see the risk of an unwind in the carry trade because the market can adjust and react, right? It's the rate of change, it's the speed at which this pair could move that eventually could cause problems. But up until the point it moves slowly like this, I don't see that type of risk for markets, right? Completely skipping the other type of currencies for now. Just a quick look at a monthly time frame, and again, just let's get rid of all the drawings. But if you start to zoom out enough on a monthly time frame like this, although in the short term, so over the last 3 months, maybe the dollar weakened a lot against the other currencies, but if you have a look at these charts, look at the euro, look at the dollar Canadian, look at the Australian dollar, the Japanese yen, and even the British pound. I mean, if I told you this is a 5 minute chart, would you be bearish or bullish at the end of it? You know? Now, sure, the market right now is going in a little bit of a consolidation. You could also say maybe the euro and the pound are looking a bit better than the rest, but is it really, overall, the overall context, it's really showing that the dollar is doomed. And again, if you do the same on these other currencies, so the famous BRICS, right? If you look at a long-term chart of the Chinese yuan, the Indian rupee, the Brazilian real, the South African rand, even the ruble, right? Does it look to you like a bull market in these currencies or not? So again, at the end of it, the DXY, it's majorly weighted against the euro and the yen. But if you think of the role of the dollar as the reserve currency, as the most used currency for global trades, I keep on thinking the dollar is here to stay. Sometimes I just, willingly exaggerate this entire thing, saying, yeah, maybe the dollar is going away, but not in my lifetime. So, obviously, it's just exaggerated, but it's just to point at the fact that these things they can take decades to play out. And we were analyzing that that quote of the dollars being due, getting back to the 60s, and the dollar is still here. So always be careful with these assumptions and narratives, right? Let's have a look at oil. Let's start out on the monthly time frame right away for oil. Okay, so what do we say? So the month of what was that? March was essentially a breakdown. If you consider the overall support right here, right, or the gray area, which anyway this is established on the daily time frame, but it looks like it holds a little bit of a water even on the monthly time frame. So it looks like we just broke down, and now we just tried to rally, and we closed the month with a little bit of a indecision. you know Rally up, push down, but not really making new lows on a monthly base, but at the same time not really bouncing hard. So I keep on saying the same, like if you zoom in on a weekly, what do you see? See an impulsive move down, exhaustion to the downside, start to bounce. The bounce is faded, but it doesn't go for new lows, so another bounce. So what's next? Are we gonna fade this bounce as well and maybe revisit the lows of this new dealing range again? It could be. I mean, over the last 2 weeks, my main disposition on oil was neutral, range bound up until proven otherwise, with a slight, bearish bias overall for fundamental reasons and whatnot. So I I would say, nothing really happened on, in this market for me to having to add more to it or changing my bias overall. Um, I think there was a piece of news coming in. I don't remember from what country. It was one of the OPEC plus members. But again, they were still talking about increasing production. So again, that shouldn't really be in favor of oil to appreciate a hell of a lot. Now, there is a positive aspect in all of this, in this weakness in oil. Now, I'm not gonna give you the entire story, and sure as hell, I'm not gonna go through all the different charts to make the comparison, but just, you can verify it for yourself. The fact that no matter all the narratives, no matter all the doom and gloom and bearish porn you can find out there on the internet about the US economy and the recession to come, the imminent crash, right? I think, the fact that oil was so weak throughout all this period, well, actually contributed to prevent a recession in the US. Because if you check, getting back to, well, I guess the last 30, 40 years, what you're going to notice is that ahead of every recession, you had an oil spike, right? And I guess, the logic is always the same. The economy is already fragile enough, the consumers are already tapped out. You got an oil spike for whatever reason, geopolitics, supply constraints, or whatnot. And so you have an inflationary push. Consumers can afford to pay higher prices, so they just give up. So consumption stops, money flow stops, money circulation stops, and that's how the economy and the system comes to some sort of a halt, or a contraction, which is a much better term in this case. So could it be that if and when we see an oil spike particularly violent, that puts the final nail in the coffin for the US economy to be resilient? I mean, it could be happened in the past, so I don't see why it couldn't happen now. Um, Other people might think maybe this time it won't be oil to trigger that. Could be tariffs, because we do know, right? Tariffs are massively inflationary. Although now, even what was that? I don't know if Goldman Sachs or JP Morgan, they just revised their stand on tariffs being inflationary. They actually said now, well, actually, we revised our data and our studies, and now we do think tariffs add more a disinflationary push to the economy than an inflationary one. No shit, Sherlock, right? But, anyway. So that would be oil for me. And again, for now, we'll see next week if something moves because, it's just going nowhere. A lot of choppiness, and that's it. Let's have a look at gold. Gold was interesting, and actually, it traded exactly as expected. If you remember last week's video, I didn't take the time to put together the recap as I did last week because I'm gonna have a long weekend because of festivity on Monday, so I'm getting ready to head out and stay out a bit. Didn't want to waste a lot of time. But if you remember, you can just check that out if you don't. But we were looking at oil hitting kind of this trend line right here, saying we might have a push to the downside, a little bit of a rejection here, and the market being relatively choppy. But overall, and I remember quoting myself, I said probably it's gonna take more than 1 week, so don't expect it all this week, but we might consolidate a bit and then again trying to reaccumulate and trying for a push higher. We got what? Half of it because we actually had the push down and the sort of reaccumulation and a push to the upside once again, but we ended up hitting the trend line once again and closing the week on a little bit of a weakness. Nothing major to be fair, but weakness nonetheless. So didn't really push out of this trend line. And at that point, I guess, when it happens, I guess that's the green light to start to aiming for new highs on gold. Now, in the meantime, does that mean that we couldn't see a bit of a farther push down? Well, I guess it is absolutely in the cards. Why not? Again, we were running off the assumption that we are now trading into something like this, right? Some sort of a wedge. So, even if we get back around what, 3,200, it would still fit the overall narrative. So, at the end of it, if we zoom out a bit, like on the weekly time frame, we have seen this type of exhaustion right here, but no really follow through to the downside. Now, last week we got a nice candle to the upside, and this week we just pull back, basically getting back in the middle of that previous weekly range, and so far we found support there. So again, I wouldn't be bearish on gold at the current moment in time. Sure, maybe you could say that if I was particularly bullish, let's say 1 month ago, now I'm a bit more neutral, but still slightly bullish oriented over the mid to long term. And even with this one, if we look at the monthly, what do we see? Well, I mean, basically, we see that we ended up the month of April with a massive doji. So we traded in between the previous monthly range. We didn't take out the highs, didn't take out the lows. And at that point, I think, the simple way to assess it would be which one gives out first. You know, uh, if we would have taken out a previous monthly low, then again, maybe we could have started to talk about a top. And at the same time, if we could have taken out a previous monthly high, we could have talked about continuation. So if you expand that same type of logic to the to the current month now, getting into next week, you could say, you know what, now we got April high right here and April lows right here. So from here on out, the first of those which goes, that would set the overall bias for the month. Maybe, I guess, some folks could do it like that. And at the end of it, these sorry, May I said April, but it's the month of May, the one we just closed. But even if you remember last week, I said if then your point of invalidation was around here, now you could move it up right here, which, you know, incidentally, it happens to be the May low. So yeah, middle of May. And the high of the month was here, May the 7th. So yeah, I mean, again, it could be. So overall, still neutral, maybe a bit more choppiness, but up until the point these monthly low holds, should be still overall bullish on gold, right? Let's have a look at Bitcoin. Yeah, forgive these sketches right here, but we might talk and discuss about them in a minute. But I just drew them. Actually, last night I was having a very sound and solid conversation about the current state of the market for Bitcoin. So let's take them out of the way. Now, basically, the premise was this: we were looking at this formation right here compared to the one below. So uh, this one, while the market was particularly bullish, we were looking at this formation while you got a range, which should be this one right here, and on the sketch should be this one, right? Break out of that range, and at the same time breaking previous support and flip resistance, and now it's resistance. Getting back into it, so in this sort of a base that we established, right? Bouncing off of it, as you see in here, and you got continuation. Now we got kind of the same type of phenomenon, right? We got a range, we break out, we retested it. You have to account for the Bitcoin volatility, but nonetheless, we retested it and we bounced off of it. So it would be like this is the initial range. We break out, we retest it, and we go up. Now, then we go up. So you expect when you do retest the current range now, or the the nearest range available on the chart, which in this case should be this one, you expect it to react positively as the previous one and for price to have continuation. While instead you had a little bit of a fade and now you are back in the previous range. So not the most short-term bullish scenario for now. And even getting back to last week, the assessment overall was, it's a bull market until we are proven otherwise. So up until the point Bitcoin can hold this region, which was, resistance, then broke and flipped and fuel the move to the upside for new highs. So up until the point this region held, we got positive momentum. Now it's true, this is a weekend, so, put on it the way it deserves, but it looks like so far with the Friday's close, we just fell back into this range. So not the most immediate type of a bullish scenario you wanted to see. I think, as we were discussing, the problem here is that the bulls need to show up as soon as they can. They're kind of on the clock because if they fail to show up, or maybe they already failed, but I would wait for Monday to judge it. But the problem is that the entire thing it risks to lose momentum and to see some sort of a volume shift. For now, I would say, we are not really saying selling pressure. So still, I guess it can be saved. It looks a bit more of a buying exhaustion rather than selling pressure increasing. But, again, it doesn't take a lot at this point. We are at what? 103K, 100, yeah, more or less. We're there. 100,003/500. So if we manage to crack the 101 level, I think at that point you should start to be worried in the short term. And conversely, up until the point this region hold, we might establish a new, we could get back to trade in the old dealing range, right? We'll see how it plays out. But for now, if we were massively bullish before, now just curb your enthusiasm a little bit and see what happens here. Let's try to do the same. Let's get rid of the sketches. So on a weekly time frame, I mean, is it really bad? Well, look, we came from 1, 2, 3, 4, 5, 6, 7 weekly advances. I mean, it's just natural that at a point you're gonna see a bit of a pullback, right? Markets, they don't go in a straight line. They ebbs and flows. Um, at the current moment in time, while I'm recording, we didn't even take out the previous weekly low. So, again, as I said, it can still be saved. We'll see about that with a weekly close. I'm probably not going to be around to look at it. But, looking at the monthly chart, to me, it's still hard to be bearish on this one. I mean, I guess if you are really, really bearish, what you could say is we got our monthly close now, or I mean, we're going to have it in another 14 hours. So we just swing failed the previous monthly highs. That failure should lead to a little bit more of a pronounced pullback. Okay, maybe. But look at the other side of the coin. If you judge it on a closing base, up until the point we close above these, so that would be the February open, right? We are still operating on higher highs and higher lows. But it is much more evident if you look at it on a line chart. So up until the point you close above the February close, or in this case should be the, no, it would be actually January. Yeah, the January open right here, which incidentally is also the yearly open. So up until the point we close above this swing, uh, it's still a higher high on the monthly time frame. Now again, inside the month, it could ebb and flow wherever you like, but overall, the trend, the long-term trend should remain intact. So just always be careful to to look at this market from different lenses depending on the time frame you're looking at. All right, because if you look at it for the mid to long term, I mean, Bitcoin could very easily come back at 96 and still maintaining this overall bullish posture from year to year end at the end of it. So, all we are discussing right here, it's just short-term fluctuations. It's just that. It doesn't really change the macro picture at the end of it, right? Just bearing in mind. Now let's move on to the bonds. Bonds had a good week overall. I mean, they were positive at the end of it. If you check the week, green week for the long end and the medium end and the short end. But zooming out on a monthly time frame, again, I'm sure everyone is saying the bonds are set to collapse. But the more you zoom out, the more you see again this some sort of divergence, right? The long end, it's much more weak. So if you look at longer dated bonds, the medium end, it looks a bit more like sideways, and the short end, so the short term bonds, so the T notes, it looks a bit more like a reaccumulation with a slightly bullish tint in the short term. And again, short term on a monthly time frame. Just make sure you're taking things in the right context here, right? Now, I think at the end of it, what we've seen this week was kind of expected for bonds, because if you remember, we were talking about the narratives, we were talking about the positioning, which was really exaggerated. So it's not surprising to see this bounce right here. So conversely, if you look at the yields, I mean, look, they just came down a bit. Now, does it mean they topped out? No, it just means they are just, again, ebbing and flowing around. Uh, and you can apply the same type of analysis, right? Overall, it looks like the long end of the curve, it's much more bullish. The medium end, or the central part of the curve, it's a little bit more sideways, and the short end, it's a bit more on the bearish side, so lower rates on the short end. What I'm really struggling to get along with, it's it's this narrative by which, if you open up your FinTwit, or Twitter or YouTube in general, yields are allegedly skyrocketing to the upside. So maybe it's just me, but I would be curious to ask, what is your definition of skyrocketing? Because as far as I can see, even if you take the long end, which is, as for the yields, the more bullish you can look at, it looks to me like we are still trading in between the October 2023 highs and the December 2023 lows. We didn't break out of this range, right? So, and it's even less bullish if you look at the other durations. So when you say skyrocketing, and again, maybe it is just me, right? It's a matter of terminology and expectations and overall biases. But from something which is skyrocketing, I would expect it to go up pretty much every single week or every single day. Don't see it right here, to be quite honest, right? It goes up, comes back down. Yeah, then it goes up, it comes down again. It's not like every single week you look at the charts, you're looking at the yield, which again increased another 10, 15 basis points. Next week, 10, 15 basis points. And you end up after 6 months, yields are up, 1.5, 2 percentage points. That would be my definition of skyrocketing, right? Uh, if you tell me about these price segment right here, right, something like these, okay, now I could agree yield are skyrocketing, all right, but in here, uh, and furthermore, if they were skyrocketing here, right, why the media weren't calling for yields to plunge in here? So this is skyrocketing, but this is just a pullback. And overall, we are still trading in the same dealing range. So quite honestly, I don't get it. Now, I guess the most important question could be, at the end of it, if you're worried about the impact on economic growth, are yields too high, too low, or are just, in that sweet spot? It's kind of like you take a shower when you take a shower. How do you like the water? Well, not too hot, not too cold, right? So I wanted to bring up something. Now, let's have a look at the numbers, right? So the 10-year, it's now trading at 4.39%. Let's round it up to 4.4. Okay. The long end, it's trading at 4.92. Let's call it 4.9. And the short end, it's trading at 3.9. Now, look, this is not some complicated type of math. I'm sure there are many other different tools to be much more precise. It is just a general idea. It's just general demonstration, right? But if you just take a calculator, and it doesn't take a genius, but if you go like, 4.9 plus 4.4 for the 10 years, plus 3.9 for the short end, and then you divide it by 3, you got an average of 4.4, right? So which is basically the 10-year, right? Now, when you go and check what's going on as for GDP in the US, all right? Where is GDP now? At least, the last year-over-year read as for quarterly releases. It's 2.1 for Q1 2025. Okay. Where is inflation as for the CPI? 2.3. 2.1 plus 2.3 equal, 4.4. Wait a minute. What was the 10-year? It's just 4.4. at the end of the month. Could this be that at the end of it, I mean, it's just a big assumption, but could it be that at the end of it, regardless the debt, the deficit, the US dollar doom and gloom, maybe, just maybe, yields are tracking economic growth and inflation, right? I know it's some sort of a leap to imagine, but could this be, right? No, I'm not, of course, you can tell I'm joking, but again, um, many different things going around, but at the end of it, if you just look at the long-term trends, you might have spikes here and there, short-term ebbs and flows, but the normal thing would be having yields kind of tracking what's going on as for inflation and economic growth. That's it. And if you zoom out, what you see now is that economic growth, it's slowing down. Is it crashing? No. Are we going to have a recession in 2025? Who knows, right? I'm just saying the data is saying economic growth is slowing down. Inflation, what is inflation doing? Oh, looks like it's slowing down. And actually, we are back, and we have been back since basically what, September 2024, at the same level we were at in 2017, 2018, and 2019. So uh, at the end of it, why wouldn't you expect that overall, when the narratives wear off a bit, at the end of it, yields should track what is, you know, perceived in these type of data? Will yields get back, below 2% or below 1%? I don't think so, unless we really have a recession. But could they? I mean, would it be unusual to expect the 10-year to get back below 3.5? I mean, no. I guess no. If GDP at the end of the year for 2025, it's going to be around, I don't know, it could be right 2.5, 2%, right? Would it be uncommon to see these one trading at 3.5 or whereabouts? I don't think so. Now, again, this is a long-term type of bet. We will know in another 6 months or 1 year, but it's just the logic behind it that oftentimes it just, it makes me laugh a bit. But, just, different type of view that you might have on these assets. Do we have time? I don't know, maybe not, but do we have time to look at the trades? I was eyeing uh, last week when I said there must be a brewing opportunity in here for the bonds. Yeah, maybe there is. Okay. Let's start out. Now we are looking at September futures, right? So for the long end, right? So T-bond. Let's start out with the daily time frame, and remember the context. US downgrade, bonds are going to hell, and all the rest. Okay. So we got the initial spike down, market starts to come back. We testing these daily point of release. So, you would expect if it's really bearish overall, you would expect this area to act as resistance and to have continuation. And we didn't have it. So as soon as we don't have it, you zoom in a little bit, what you see is that, we came down off of the narratives, the bond 20 years treasury auctions, it went badly. The Moody's just downgraded the US debt. Okay. So this point right here is tested now. You should expect continuation if the narrative is correct, right? Instead, we find support. So we go for a higher low, not a lower low, no continuation, right? So we establish the space and we rally back up again. And we fill in this inefficient pocket. Okay. So at this point, basically, you got the green light for your trade, right? It failed to continue down. The narrative is proving wrong. And technically, we basically tapped in all the potential resistance level that we could have on the way up, right? So when you see price getting back into the base, which originated the last push up, and basically get rid of what could have been deemed as your first trouble area, you know, the assumption is if we bounce from here, the next area would be the previous resistance area right here. So then you zoom in once again, and what you have at this level is, you know, your weekly open, nice level, because the weekly opened up in here. You saw on Monday a push down, reaccumulation. We get back above the open, and on Thursday we retested it. And look at the sharp bounce it had, right? Now a little bit below the weekly open because of what? Well, because of this, essentially, at the end of it. Because of the breakout tag or the point of release, which completely broke out of weekly open after the Monday push to the downside, accumulation below the open, breaks up above it and keeps on rallying for the rest of the week, comes back into it. Here's where you got your liquidity injection. Here's basically I mean, it is inefficient, but you need to look at this range as a range which is already balanced out. It was traded inefficiently to the downside, and it was traded inefficiently to the upside. So it's completely balanced out now. Of course, your stop goes a bit below it. Um, could the market actually trade back into this area, stopping you out and then going? Yeah, it could, but you need to take a bit of risks sometimes. So this one played out well, and that was the setup brewing on the bonds that I was expecting. Now, does it mean that bonds are now doomed to keep on going lower? I don't know. But it was a short-term trade at the end of it, so I was just looking at a short-term type of swing to make some easy buck, right? If we keep on having continuation to the upside, it doesn't mean that you're not going to have another setup to the upside once again after we maybe clear this area and keep on rallying toward these high or whatever. But that was the easy one. So it also hit TP right on Friday before closing the week. So why not? Don't be greedy. That would be it for bonds again. So let's see. Should we move into stocks now? All right, let's do it. So as for the equity market, wild week. let's let's have a look at is trying to zoom in. So we started out on Monday and immediately we pushed to the upside because of course, the same as we went down on Friday with Trump announcing, but if you remember the wording and the language, I'm going to advise a 50% tariffs on the EU. But then again, of course, throughout the weekend, no, look, yeah, I told that, but it's suspended, all right? I'm giving them up until, what was that, July the 9th to come to me and negotiating. So they're not going to be in place. And of course, another tariff pause, the market immediately rallied. Now, it kept on rallying throughout the rest of the week up until the point we get into Wednesday, where things went really crazy from from the standpoint of the news with the economic calendar kicking in, and again more news. So don't discount the other very impactful event of the week. Everyone was waiting for it. So Nvidia earnings, right? Earnings which came in way positive. They they managed to beat expectations, and even the guidance was good enough. So a tiny parenthesis, but it, everyone keep on saying Nvidia, it's the next Cisco, it's gonna end up the same Cisco did in the .com. Well, yeah, but maybe not. There is a huge difference in between Nvidia, well, maybe a few other AI companies. The problem is that back in the .com bust, those companies, they weren't making money. that weren't generating revenues. Nvidia, it's growing revenues. I don't know if we've ever seen something like it. Will it come to an end eventually? Yeah, absolutely, it will come to an end. But for now, especially if you look at metrics which go a bit beyond the simple PE ratio, if you look at the PEG ratio, I mean, you could also say Nvidia is fairly priced. If not, throughout the recent dump that we had, a bit underpriced or undervalued for the amount of revenues it generates and the perspectives of future growth that it has. So it's another one of those narratives. Always pay attention to them. They could put you in trouble for real. But anyway, we got the Nvidia earnings and the market kept on rallying. And on top of it, it was night for me because it was really when I got back to it, it was already I realized it was happening at 1 a.m. during the night while I was asleep, but probably was maybe 7 p.m. Eastern time. So anyway, the here is where we got the court saying tariffs are illegal. So again, if tariffs were the main drag on the market, and if we already rallied on an announcement of tariffs pause, if now tariffs are illegal and they are all going away, we are going to rally even more. So the market had this massive overnight type of rally, and it was completely reversed throughout the rest of Thursday session because many different things went on throughout this day. Thursday and then into Friday as well, because not only we had the administration appealing, and therefore the tariffs were kind of saved for now. And again, we don't know how long that is going to take, if we're going to get to the Supreme Court or not. We don't know yet. But the market just sold off once again. And then, throughout Friday, we got a few other announcements, especially now. I guess I don't know if the timing is right, but I just remember Trump said that China it's massively violating the terms of the agreement of the deal they managed to make in Geneva. Not, well, when was that? 2 weeks ago, maybe. And then, the knee-jerk reaction by markets was to plunge because, oh, well, so the deal is already off. Well, they violated. You can't trust the Chinese once again. All right, okay. But the day ended up with Trump saying, "Yeah, but I'm gonna talk with Xi and maybe we can sort it out." Um, Again, the market will move on these type of news hitting, but you know, more often than not, I guess it's not like you can really predict these type of movements. But just looking at what happened into the past, like for instance with Nvidia, right? We've seen the earnings coming in after the close, right? Now I'm looking at extended trading hours just to be able to see what happened throughout the night. Okay, and over the following 2 days, so Thursday and Friday, the market completely gave back all the gains of the previous day when earnings were released. So again, if you just check what happened, at least recently, with all the Nvidia earnings, I mean, it's not to really brag, but you know, was it something you could have put on your bingo card, right? Then again, you might say, okay, but it was because the court and then the appeal from the administration. Otherwise, the market would have kept on rallying. Maybe, maybe not. I mean, those are things you cannot really forecast, and you don't have any precedent to judge upon. But the fact that recent Nvidia earnings was a bit of a trappy trap, uh, that was a given. You could have seen it in price action if you just checked what happened throughout the previous data release, right? Plus, let's get back to the daily time frame. The market was already up substantially. It started rallying way ahead of the earning release, right? So even if earnings actually beaten expectations, was it kind of maybe, or to some degree, a bit priced in already? Not to mention, didn't we hit back in a previous resistance? So at least, initially a bit of a pullback was due. Does it mean Nvidia is going to crash? I don't think so, but we are just retesting back into resistance, so maybe we have a little bit of a pullback, right? So that was the fun part of the stock market. From Wednesday to Thursday was very movement, excited market. A lot of movement. Let's put it this way. Now, what really changed for the big picture? I guess really not a lot because this type of a choppy action was kind of forecasted in last week's video. We were discussing about the possibility of markets being a little bit sideways in this region. Uh, Most precisely, we were looking at the moving averages, and if I remember correctly, I was saying probably we chop around these clusters of moving averages a little bit more. We might get a bounce and testing back into the high side of the range, but overall we should at least stay relatively choppy overall. Now again, the question was also uh, it's hard to be bearish because up until the middle of June we are still counting on the corporate share buyback, so don't expect the market to immediately plummet from these levels, but still working off a bit of these overbought condition could could be a good fit. We did have momentum as for the stochastics starting to cool off. At the end of it, when you look at it, if you see the market keep on going sideways while the stochastics it's just resetting itself, it's not a bad sign. Actually, it's a bullish reset at the end of it. Same for if you look at the RSI, what you see a bit of divergence now, especially on the Qs. Do we have the same on ES or SPY? Well, on a closing base, yeah, we have a slightly higher high here, a much more pronounced higher high here, with the indicator making lower highs. Sorry. So maybe again a bit of a subdued type of a upward push, even next week could be. Uh, the MACD it's working on we got divergence even on the MACD, and now it looks like we are trying to confirm a bit of a sell signal on this one. Probably it's gonna be mild, right? I mean, just because you have a little bit of a divergence and a sell signal on the MACD doesn't mean the market is going to crash. No, I don't think so. Especially because at this point, if you look at the moving averages, the trend is still to the upside. But again, maybe as for last week, the best scenario for bulls is keeping on working off these overbought condition and going sideways a little bit, potentially grinding a bit higher. I think at a point we're gonna need to pick up some liquidity to the downside below actually pushing higher, if that's your bullish scenario, right? We still have an open gap below. I don't think we are at risk of feeling it right here, right now. Actually, this thing about gaps, it is true that all gaps they do tend to fill sooner or later, but the more the market leaves it open, the more it shows you that there is buying pressure. So we are not even able to get back and fill the gap. Um, but on the other hand, you could keep on saying to yourself, yeah, but gaps are kind of like a no trading area where no transactions actually happened. So the market is naturally curious and will gonna and it's going to try to go there and check if both buyers and sellers are on the same page in their gap and look what we can find there. So just to test the overall sentiment and look if we are all the same page and we can keep on rallying after filling the gap. I guess both are valid in my view. But overall, it doesn't really change my kind of idea of, you know, still bullish oriented and still maybe a bit more choppy, maybe a little bit of a subdued type of upside. But, if I have to pick, I would pick a bit more of upside, or at least upside attempts, rather than an immediate crash and crack back below the moving averages, or the support will be just confirmed, right? So that would be the assessment for the stock market, in my view. Now, the volatility, so the VIX didn't really move a lot this week, so I guess it just reflects the overall tendency of being sideways as for the markets. Um, Other than that, I think there's really nothing new. I think this week was you know beyond the intra-week fluctuations and the intraday volatility. Uh, doesn't really change a lot for the big picture. We are still kind of in the same situation we were last week. Uh, like, look, if we let's try to put it this way: if we zoom out as we did for all the rest on a monthly time frame, I mean it's it's hard to be bearish after a month of March, which closed like this, and again a month of April. No, sorry, a month of April, which closed like this, and a month of May, which closed like this. We are still seeing the Qs leading the charge. And again, I said it in the past, and I'm gonna say it again. I think true bull markets, or if you want a confirmation of bull markets, you wanna see the Qs or the Nasdaq leading the charge, right? So it looks like in this case this is happening. So I can't really be bearish on the stock market. Do we have the usual risks as for the economy? As we discussed, the labor market weakening, the GDP growth slowing down a bit. I mean, yeah, okay, they're there. Are they enough to tell you that we are going to have a recession or a financial crisis over the next, I don't know, 2 months? No. So, uh, softening data are not necessarily recessionary data. They could lead into a wide open recession down the road, maybe. But again, for now, since we are trying to assess these markets week by week, um, it's just, you take that risk in the back of your mind, but it's not really reflected, or at least the market it's not pricing that in right here, right now. Otherwise, again, you take the chances of being the one predicting the crash, and eventually you'll be right. But if in the meantime the market rallies another 10%, not to mention uh, it already rallied what 20% off of the lows. Wait, am I right? Only 20%? Well, I mean, SPY to the current price level, yeah, 20, 21. Okay, so not only you risk to keep on mm, staying out of the market and not participating in the uptrend. But God forbid you are going to try to short the market every single week. You're going to be in profit for maybe 1-2 days, and then the market is going to come and hunt down your stop loss on your short. So, bear in mind, overall, it pays up to be a natural bull in these markets. All right. I don't really think there is much more to be said about markets this week. The video is already long enough, I guess. But if you notice, beside the initial 15 minutes talking about a few data points and macroeconomics, all the rest, I wanted to structure it in a much more chart-oriented type of a video. I don't know. Maybe I guess people like to see charts more. I don't know if it's out of pure interest or maybe. I mean, I hope they don't, but just a little bit of a disclaimer. If you think you can grasp what the market will do next week, I wouldn't count on my own advice, because I get it wrong many times. And at the end of it, I don't even care for real what the market is gonna do overall. I'm a day trader at the end of it. I mean, it's all fun and good having these recaps and trying to establish the bias for next week, but you know, even if I'm massively bullish on the stock market, it could very well happen that throughout next week, the majority of my trades will be shorts, because in the end I get in and after 20 minutes I'm out. So yeah, I could just fade every single move up. Uh, it, is it bad? Is it good? I don't know. If it works, right? So again, don't trust my judgment for your own decisions, I guess. And with that, I'm gonna leave you off, wishing you a very good weekend and a very good start of next week. I'm not gonna be around on Monday again, festivity here, so I'll check the markets on Tuesday most likely, and we'll see for the next week what the market is going to do. Be safe, and of course, as usual, be nice and be cool. Neil's out.